tax. Well, that also business today is filled with good news. Majority of the banks have released their 2020 financial year results, with many recording a drop in profit due to the COVID-19 pandemic disruptions for a sector that is known to be resilient. Are recent results reflective of the sector's future? KTN's Noah Kipkemboy delves on that.
The COVID-19 pandemic did not only shake the global economy, but left a trail of economic destruction in the banking sector.
2020 was a challenging year in its own ways.
2020, as you know, was also a very challenging year, thanks to COVID.
It was a year with difficulties. We also felt firsthand the difficulties for COVID-19.
Leading banks in the country recorded a decline in profit after tax. Tier 1 lenders such as KCB's net profit declined by 22%, Equity banks by 11%, Standard Chartered by 34%, and NCBS by 42%.
I think the big story for us in 2020 was on provisions. We structured 78 billion worth of customer loans.
We also saw our profitability drop to 7.5 billion, which is a result of what was happening last year.
Our LI moved from 0.6 billion to 3.9 billion as a consequence of the tough macroeconomic environment because of the pandemic.
We had to accommodate and provide lower fees. Most of the fees were actually waived because of the difficulties we faced in 2020.
But to analysts, of key concern is the health of the loan book, which we saw 57% of the total loans worth over 1.7 trillion shillings was restructured.
And if loan losses continue to mount, then there's a risk that after 3 years, the banks will need to start raising Tier 2 capital. And by the way, we've already seen a couple of banks raising Tier 2 capital, including Equity, which signed up a lot of DFI funding over the last 6 months.
More investments in government securities drove asset growth, with technology boosting customer deposits.
Customers were actually pushing money into the banks via channels. So this could have been, because of the prohibition on cash and the customers trying to minimize the exposure to the brand.
We witnessed that 67% of our retail clients continue to engage with us digitally, and most important as well is 47%. There was a 47% drop in branch footfall as clients moved on to digital channels.
We've halved our transactions, either at the individual level and either in full level transactions. And this is a great story. It means we can use our branches for much more value-added services for our customers. We can do the SME and micro enterprises we want to be able to do. We want to support our women entrepreneurs, and that will continue to be. But those transactions are then migrating into our digital channels that we're going to be able to see.
The central bank says 95% of restructured loans have resumed repayment, but maintains that the credit risk remains elevated in the banking sector. Noah Kipkemboy, KTN News.